Allow us to quickly move on to this gathering that broke all records. Tom Lee is the head of research at Fundstrat Global Advisors and a writer to CNBC. He is now joining me. Tom, thanks for being here. This morning, the Dow went up 1,500 points. That's a move we haven't seen in 2 years. What's next? Wow! I believe that today's events clearly demonstrate that the market did not anticipate the result of the election. If it did, the market would be flat. A lot of investors lower their risk before an election because they think there will be a lot of social unrest, etc. This is something we could tell by talking to our clients. Thus, I believe that money is being used, but in a way that shows a lot of animal spirits in the areas people choose, such as small caps. Just so you know, Qualcomm's earnings report is out now. We're going through it now and we'll send it to you in a moment. Mike Santoli is also here now. I'm going to ask Mike for help with this. The Trump trade has been clear today, as seen in the stronger dollar compared to other currencies and the general rise in stock prices, especially among steelmakers, banks, and other companies that tend to grow quickly and without many rules. Bitcoin is also more expensive. However, there have been sell-offs in this market as well. People had different ideas about whether the so-called Trump trade would happen or not. What do you think? We can see that it's happening, and it makes sense that it would, at least at first. On most of those fronts, I think it's just been an extra push for trends that have been going on under the surface. Leadership has been coming and going for a while now. Since the Fed cut rates, yields have been going up, the dollar has been pretty stable, and economic shocks have been good. Now it's time to use some of the strategies from 2016 and maybe make them better. Small caps are moving, and banks are making more and more money. There is a question about where to start though. In terms of prices, inflation, deficits, and current growth rates, we are not quite at the same place we were in 2016. In terms of how investors felt, the market was flat for 18 months before the 2016 election. Since then, it's gone up 40%. If animal souls have been sleeping, I don't think they are. I think this possible policy mix has woken them up. To begin, let us look at Amazon. What did you think of the finish line? It looked interesting to me. Even though cloud didn't meet expectations, the price is still going up. That's right, yes. Some things were wrong with Amazon, and after yesterday, you might have thought that everything would be punished, but not Amazon today. A big surprise in the quarter was a huge profit on the bottom line, which gives investors peace of mind. I think that had a lot to do with that. Since sales were close, it's not a surprise that stock is up. It hasn't been one of the best mega tech companies either, so there's room to grow. Amazon has really impressed people who spend. What do you think about this? They raised CapEx by 81% while seeing margins grow. It's hard to do that. It really is. It was important to know the CapEx number. They are still focused on CapEx and spending huge amounts of money. We've now gone over the big CapEx spenders and the cloud spenders. Because of what Jassy said about AI and how they focused on that, the story goes on. Nvidia is the last of the Magnificent Seven to report, so it should be a good read. Let's talk about Apple. The price of shares has dropped by just over 1%. It looks like advice, but there were some good things, like the comment about the iPhone and a 6% rise in sales. But Gene Munster from Deepwater thinks that revenue will grow by only 4 to 6% this quarter, which is less than the nearly 7% that was predicted. Given the good things, does that make sense? This year was a good one for Apple as they got ready to release the iPhone 16 and AI, but the features weren't as good as they were promised. The stock is only slightly down because sales were better than expected. Apple hasn't done well lately, so a 1% drop isn't too bad, especially since the iPhone 16 is coming out soon. Because Apple is so big in the market, I agree. But does this 1% drop, even though there are some good news, show that investors are paying attention to forward P/E value and perfection pricing? That's what we saw was chosen for the Dow instead of Intel, given how important Nvidia is to the economy right now. After the fact, you could say it's a momentum play. Both Apple and Nvidia are about the same size, but Nvidia makes a third as much money and Apple makes half as much. It costs more, but the value of the stock grows faster, since not much money is tied to. Okay, that's all good information. But I'd like to learn more about what Nvidia's addition to the Dow means for the market as a whole. Does this change in the index tell us anything about the direction of the market or where buyers might look next? To be honest, maybe. The fact that Nvidia joined shows how much the tech industry affects the economy and how AI and high-performance computers are becoming important growth drivers. But since the Dow doesn't have much of an effect on flows, it's not a perfect sign of future trends. It's more of a sign that tech is still important, and investors may be right to focus on stocks that are driven by innovation. It doesn't mean, though, that the rest of the chip industry will perform as well as Nvidia. Now we'll talk about cyclicals and the Trump trade. Do you see any areas where investors' excitement might be getting out of hand, especially now that we're thinking about possible rate hikes or policy changes? That is a good point. Industries like industrials, financials, and materials are all making big gains right now. This is because people are expecting growth to pick up and regulations to be eased. But because of the uncertainty about rates and the fear of inflation, we might see some giveback if those expectations don't come true. For instance, financials might have trouble if rates don't keep going up or if the yield curve flattens. So, it's not always a good idea to draw too many conclusions from recent trends, especially when macro conditions are changing. Now let's talk about the Federal Reserve. More and more people think that rates might go up sooner than thought. Do you think the market is taking the Fed's moves into account? What might that mean for different areas? The market is paying close attention to the Fed's possible rate hike, and there is some hesitancy as buyers think about when it should happen. High interest rates may have a bigger effect on some industries, like tech, that need cheap cash to grow. As we already said, cyclicals and financials could do well if rate hikes mean that the economy is growing faster. But if the rate hike happens too quickly, or if inflation stays high, the market may lose interest in sectors with high prices, which could cause money to be moved to defense or yield-focused assets. When we talk about defensive investments, are there any areas or assets that you think will do well if there is more volatility after a rate hike? Of course, during times of uncertainty about interest rates, investors may look for safer investments. This could help areas that are already doing well, like consumer staples and utilities. REITs might be appealing because they can bring in money, but they are subject to rate hikes. If prices go up, bonds, especially short-term treasuries, might also become more popular as a safer choice. It's possible that the market will move towards a more balanced approach, with a mix of growth and defense positions. Let's get closer, and small misses are making people react more strongly. The bar is very high for the Magnificent Seven, so even small failures can lead to pull. One last question. Investors are interested in international markets, especially those in developing economies, because they still see growth opportunities, especially in places where prices are lower. Since the dollar has been strong lately, investors in the US may face currency headwinds, but there are still chances in places like Asia and Europe. For example, China's economic rebound could help industrials and commodities around the world. Diversification is always a good idea, and US investors might think about increasing their exposure to foreign markets to take advantage of growth outside of the US, especially if the US market stays unstable. Okay, that's a lot to take in. Tom and Mike, thanks for your ideas. The end of the year looks like it will be interesting, and we'll keep an eye on those trends. Thanks once more. This should continue naturally from where the last part left off, keeping the same structure and tone. Let me know if you want more to be added.